At the end of the last week, market optimism faded away after the US confidence index had unexpectedly dropped. However, major US stock indices closed in positive territory on Friday. In our video review, you will find out how markets closed the previous weekly session and what trader sentiment is going to be this week. As we have already mentioned, consumer sentiment index tumbled to its lowest level in 10 years. Naturally, this data raised concerns about the recovery of the world's largest economy. At the same time, the US dollar remained in high demand among investors. The US dollar index, which measures its value against the basket of 6 major currencies, was holding above the mark of 95 at its 4-month high. Traders prefer to keep their long positions on the US dollar open amid expectations that the US Federal Reserve may move its timeline for a rate hike as inflation rises. Notably, consumer prices in the US surged by 6.2% in October compared to the same period of the last year, which is considered the highest reading in almost 30 years. The single European currency has been trading lower against the US dollar for the second straight week. The quotes of the pair went down below the psychological level of 1.15 and settled there. The difference in the monetary policies of the two central banks still influences the trajectory of the euro-dollar pair. While the Fed has started the tapering of its QE program, the European Central Bank prefers to keep its monetary policy unchanged. Revealed on Monday that tightening of the monetary policy aimed at tempering inflation in the Eurozone would be counterproductive. In addition, ECB President Christine Lagarde reiterated that a rate hike in 2022 was highly unlikely. In the meantime, the pound sterling finished its 4th week of decline and hit the lowest level in 11 months. Weak economic indicators were to blame for a sell-off in the British currency. The UK economy has considerably slowed down and industrial production unexpectedly contracted, thus confirming the risks for the economic recovery. This week, markets will focus their attention on the UK employment report. The Bank of England sees the health of the labour market and the employment recovery as major indicators. At the same time, investors monitor a new conflict between the UK and Northern Ireland regarding the post-Brexit trade deal. The kingdom threatens to resort to emergency measures, thus putting additional pressure on the pound. Meanwhile, crypto traders anticipate another rally after Bitcoin tested a new record high, and there is no doubt that the price of the #1 cryptocurrency will continue to surge, especially now when Apple CEO Tim Cook admitted that cryptocurrencies make up some part of his investment portfolio. Oil traders also felt the pressure of a stronger US dollar. Last week, Brent dropped by 1% to $82 per barrel. Besides, a downgraded forecast for oil demand weighed on the crude quotes. According to the OPEC monthly report, oil demand will average 99.49 million barrels per day in the 4th quarter of 2021. Higher energy prices are expected to curb the demand. What's more, markets are preparing for the US to take action against accelerated oil prices by releasing its additional oil reserves. On the other hand, the sentiment of gold traders was completely different. The precious metal closed this week with a 2.64% gain and settled near the level of $1,864 per troy ounce, reaching its highest value in 5 months. And you've watched Combined Financial Review with me, Anna Kasatkina. See you back soon.